Hello, we're back again. This is my lecture 2, and today we'll start with section C of the syllabus, which is about working capital management. We'll start with this. Arguably, I would say this is maybe the most important part of the syllabus. So I will always like to start this paper, Financial Management, with section C, Working Capital Management. And the first question you ask yourself is, why do we have to manage working capital? Why is working capital management such an important discussion in financial management? And I will take you back to that equation in our previous lecture, in lecture 1, that says assets can be financed either by using liability, which is debt, or you use your money, which is equity, or you use both. What is the component of assets? Is made of current assets and non-current assets. And this is equals to current liability plus non-current liability, then plus equity. And remember, what we are managing is current asset and current liability as working capital. And those are the things we'll be looking at today. This is working capital. So we'll start with this. And I'm asking, why do we need to manage current assets and current liability? Why is it important? And what is the answer to that question? The answer is because there is a conflict between profitability and liquidity. So the conflict between profitability and liquidity must be managed. And that is why working capital management is such an important topic. Because any company that fails to manage working capital properly is destined to fail. Now, how do we manage working capital? And also, why is there a conflict between profitability and liquidity? Let me talk about profitability. Profitability increases when risk increases. So remember the saying that the higher the risk, the higher the reward. So whatever increases your risk should naturally increase your profitability, which means investment in long-term assets will increase your risk. And likewise, investment in short-term asset, current assets, will do what? Will reduce your risk. So look at the first one, long-term asset. What are long-term assets? Those are non-current assets. So if you put all the funds you have in long-term assets, definitely your profitability will go up. I always represent profitability by lambda, so get used to that. So profitability goes up when you invest in long-term assets. But when you invest in short-term assets, your profitability will come down. So which means long-term assets, as you know, has poor liquidity. Whereas short-term asset that can be recovered in a short term has high liquidity. And you can already see the conflict. So which means long-term asset, when we merge all those together, so long-term asset is equivalent to high risk, high profitability, but what? Low liquidity. Right. Low liquidity. And likewise, short-term assets is equivalent to low risk, high liquidity, but what? Low profitability. So, if you want to have high profitability, you need long-term asset, but that will give you low liquidity. And if you want high liquidity, you have to invest in short-term asset, but you will get low profitability. So which means you can never have high profitability and high liquidity, because different type of asset gives you high profitability and a different type of high liquidity. So because you now need to strike a balance as a finance manager, you must balance this conflict such that you don't have too much liquidity that is not enabling the company to make profit, but at the same time you are not having too much profitability that poses so much liquidity risk to the company. You have to balance both, and which means balancing both means you have the right amount of current asset and a right amount of non-current asset as a company. And to do that, you need to have appropriate knowledge of how to balance these two, so that one is not more and one is not too low. Because both liquidity and profitability are important. Liquidity helps survival of a company. And that's why we call it solvency. Because liquidity refers to your ability as a company to be able to pay your immediate obligation as a full due. How much cash do you have, or how much cash equivalent items do you have, or how much asset do you have that you're able to convert to cash, like within a short time? That is liquidity. If you are not liquid as a company and creditors call for payment, if you are not able to pay, that is a risk to your survival, because the company might be forced to liquidation no matter how profitable you are. So you can be highly profitable, but if you are not liquid, you might not last long as a company. But profitability is also crucial because shareholders have invested in companies such that they can get dividends and make money. But without profitability, shareholders will not be happy. And maybe they are not even willing to pump in another cash or another fund into the company for investment. And means the shareholders' wealth is not created and shareholders are not happy, and they can also decide to wind down the company, because what is the essence of having a company that never provides a return to the owners? So this is also very important, and that is why as a finance manager you must be able to balance these two concepts, liquidity and profitability. Having said that, now, what are the items of working capital that you have to manage? So we'll look at working capital items. Like I said earlier, current asset minus current liability is equals to your working capital. Sometimes they call it net working capital. It's the same. And what are the items of current asset? You have cash. You have inventory. Inventory is very important there. And we have the account receivable. So these are the three items that we'll be looking at one after the other. We need to learn how to manage these three items such that we're able to balance the liquidity and profitability. And likewise, the current liability items includes mainly the account payable, and that is what we will focus on for this class. We'll learn how to manage account payable, cash, inventory, and account receivable. These are the four items that we'll be focusing on. But before we take them one after the other, it is very important that we learn about cash conversion cycle. Different literatures call these different names. It can also be referred to as operating cycle or cash operating cycle. It's the same thing. Some also call it working capital cycle. Don't get rattled. It's all the same. And what is cash conversion cycle? So I will start with the definition. Cash conversion cycle is the time period between the outlay of cash for the purchase. And purchase of what? You purchase raw materials, which are usually your inventory. So purchase of inventory, your inventory, or you call it raw materials. And the ultimate receipt, when you receive the cash, which usually come from where? From the sale of the goods. So look at this. This definition is divided into two parts. The first part is outlay of cash, and the second part is receipt of cash. So when you look at cash conversion cycle, you have to look at it that is a time period. There's a date that you purchase raw inventory or raw materials, and there's another date too. This is date 1 that you received cash from sale. So your cash conversion cycle invariably is date 2 minus date 1. So it's the period between when you purchased inventory, cash outflow, and when you receive cash from sale of goods. Very important. Now, there's a formula for it, and that formula is account receivable days. So which means you have to know how to calculate account receivable days, and I will show you quickly. Plus inventory days minus account payable days. And I'm going to warn you very well about especially this part of the formula, because from my experience, this is where students make mistake. In fact, some students will write the formula properly, but when it gets to calculation, they will mistakenly turn this to addition. So be very careful. Remember, Dio has warned you not to mistake this negative for positive, especially when you do your calculation. Be careful. And I say it again, be careful when you apply this formula in questions. Remember, this is negative. So cash conversion cycle is account receivable days plus inventory days minus account payable days. Now let's start with the first one, which is account receivable days. The formula for calculating account receivable days is equals to your account receivable balance divided by credit sales. If the questions does not tell you whether the sales is in credit or cash, you can assume the whole sale figure is in credit. Multiply by 365 days. That is the formula for account receivable days. We're going to look at the question that put all of this together. But let me give you all the formula. And inventory days. You can as well guess inventory days. That is equals to your inventory balance divided by cost of sales or credit purchases multiplied by 365 days. This can also be cost of sales, depending on what you're given in the question. Most likely you have one of that. And account payable days, very similar to inventory days. Account payable days is account payable balance divided by cost of sales or credit purchases. Even so as to avoid confusion, let me not use this. I will use how, so you know exactly what I am trying to do. Right. So this all and this is all. So whatever you have, you use it. Right. So those are the three formulas, and if you struggle to remember these formulas, just know that the one up, which is the numerator, is the balance of the days you are trying to calculate. So it's always that. Account receivable balance. Inventory days, inventory balance. AP days, AP balance. Now, how do you remember the denominator? Just ask yourself, how is the numerator being generated? You have to make credit sales before you can have account receivable. You must have purchased before you can have inventory. And you must have also purchased before you can owe someone in account payable. So that's how to know what is in the denominator, because I will always teach you how not to struggle on how to remember your formulas. So remember, multiply by 365 days. So those are the formulas. Now, before we go into that question I want us to look into, how do you know when this is good or when it is bad? Cash conversion cycle is good when it is low, and it is bad when it is high. So in conclusion, the lower the cash conversion cycle, the better. Now, let's go into solving the question that I spoke about, and that will take us to the next video. So watch out for my next video, and I will be solving a question on cash conversion cycle, and how to calculate account receivable days. So we'll learn how to calculate account receivable days, account payable days, inventory days, and cash conversion cycle. And that will be in my next video. Bye for now.